are in listen-only mode.
All right. Good morning. Welcome to Thursday's edition of the Watchlist. I'm Matt Tuttle, Tuttle Capital Management, and we've got Jeremy Vreeland from Bullishbrs. Um, Maybe I'll kind of start out and kind of give the lay of the land here. So yesterday was really interesting for
Sorry.
picture of your kids on bikes.
Yeah. My screensaver.
Yeah, yesterday was interesting from the standpoint that Trump didn't seem to move the markets, and I don't think he's moving them today either. Which, if you're a trader, is a welcome thing. Um, Starting to see and have people talk about kind of weakness in the Magnificent Seven, and people talking about maybe rotating out into the other 493 stocks. It's possible. I mean, it's going to be something I'm going to be looking at a lot. Personally, I'm overweighted, which again, I run a very conservative portfolio, so that's not a big deal. But compared to other things, I'm overweighted in the Magnificent Seven. I'm looking at it longer term, so I think I will continue to be overweighted in the Magnificent Seven, but we'll keep an eye on that. Obviously, Google yesterday with the street took his disappointing earnings. Amazon earnings are tonight, so that I think that's the biggest thing I'm going to keep an eye on. Anytime people, value stocks, small caps, that ends up being short lived, and money comes back in the Mag 7. So, I'm not putting a ton of stock into that, but certainly something I want to keep on the radar screen. What are you looking at mostly?
I was kind of looking around for a little bit of a forecast for price action on Amazon. And this is kind of an area where it's not interesting. So we got range. I mean, we could see a drop to 228 if things are negative in the call, and possibly a blast to 252 if things are good in the call. But it's not as clean as the one we saw with Google. And I did put out a Google earnings price action alert just to kind of put a video together and show what I was looking at. And I did state the contrarian, price targets on that for bearish move down here, like the 195, which we did eventually break. But it's kind of a crapshoot when you're trying to figure out what's going to happen with earnings. So obviously, most people who have trading experience tend to not put too much risk into an earnings call unless you're scalping it. Or in my case, I use some very limited low risk call debit spreads in this case. Lost them, but I only lost a little. If I would have won, that would have been huge. I did take a bunch of them off right at the end of the day, right in the last few minutes. And it did hit that 210 target that I had plotted out for the bullish side of the argument. During the call, of course, it got smacked, smoked right back down through all of our levels. And the next level we were looking at is the bridge between the two moves here, about 195-ish. And we also talked about the extension possible down into the lower levels down in previous support area, previous low here. And it reached that too. So it's pretty easy to plot price targets in any direction. Trading the break is the part where you got to weigh your probabilities into the trade. And if you're looking at the adage of risk a little to make a lot, that works out great most of the time. But when it doesn't, it's not a lot of risk. That's the idea. But as far as looking at stuff, I'm a little bit on the fence about Amazon earnings. I don't really see the greatest setup similar to what I would see with Google, which surprises me because Mag 7's kind of been all over the place in this earnings week. All I can do is point at Q.
Remember, Mag 7 has had a massive run since the election.
Oh, for sure.
So, things have got to calm down. Their earnings are blowout, but expectations are high. And, and to keep growing, their earnings have to be more than blowout. The thing that keeps me coming back is that all of these names span all of the themes that I think are going to be the most powerful themes going forward. And they're the 800-pound gorillas in all of those industries. So, what I kind of like to do in every theme I'm looking at is say, all right, who are the must-owns? And then who are the mid-cap, small-cap that, really have the potential to, have massive exponential returns. I overweight the must-owns, but I want the ones that have the potential for the exponential returns.
Right. And that, for me, I go for the bigger index. So I'm like in QQQ and SPY for that. If I'm running like debit spreads, I'll shoot for the range on the liquidity zone on the bull side, and I'll shoot for a mean reversion on the bear side. I can do both with that. I can run a strangle, a straddle, or condor, whatever I want to do. Problem is, once you've had the advent of the earnings event, if you're not nimble on the opening moment the next day, implied volatility will crush it. So it's really tough play. It's better to take and trade the secondary move. So if I see something that's a primary impulsive move, it's pretty sizable. Probabilities tell me, well, a reversion is likely, more likely than anything, and then we can see where the rest of the progression goes. But from a trader's point of view, it's better to take advantage of the volatility in a way of focusing on the secondary moves. So when we had the Google event, it was kind of a mute point for the indexes, and I think Amazon will kind of be too, because there's going to be equal weight on opposite sides of the spectrum at some point. So now we're just crawling sideways. Can we find any real themes in this? And yes, we can. We can shoot for a couple things that are moving. Like for instance, we found one this morning that we were day trading. Let me pull up the list again. Darn it, I get lost sometimes. QNTM there. I had it on the screen a moment ago. So this thing, it's on the verge of becoming a possible, as I called it before, a curveball thematic play into, in this case, quantum biopharm. I don't know if it's just a name thing or if it's actually got some weight to it of being.
I ran it through GPT. It looks like it's just the name thing.
Right. So it's pulling a lot of hype into it, so to speak. So we see these short squeezes all the time, and we can scalp these levels. They're pretty easy. But not everybody's a day trader.
And just one thing in their defense, I mean, quantum, I mean, that's a cool name.
Yeah, absolutely.
So, they may not be putting that name in to say that, hey, we're into quantum computing. I mean, that's just a cool name.
It's keyworded.
Yeah, I mean, it's not like, back in the internet boom where, any company in any industry would call themselves .com.
Right.
Or at the height of AI hype, you'd have companies putting AI in there somewhere. So I'll give them the benefit of the doubt.
Someone did their marketing research and it paid off. Benefit taken. And from a day trading point of view, we are able to scalp the tar out of stuff like this. This is our gravy moves. Plus, we get to teach our members a lot about price action analysis and being able to make some very, very clean trades out of stuff like this. I mean, who knows? Maybe even the fact that we're talking about it now is making it move. It's all affected, but when price action comes into play, the probability moves play out and your trading consistency gets learned really fast. Compute that into a swing trader's motif, and all of this price action looks the same on a weekly chart for other equities. So you get into some bigger weight stuff. Particularly, just an example, AMD, we enjoyed shorting the tar out of that thing. It was just high probability bearish moves, and the other day it dang near hit my target at that 104 level. Comparatively, everything you learn in a short scale you can develop into swing trading, and then compound that with the things that we're doing with letting AI do some profound amounts of research for us in a very short amount of time. Everybody's got that information, so I would lean on, and like you're in a professional standpoint, you're not day trader so much anymore. You're more of a swing trader because you got a lot more weight to move, obviously. But developing the skills of a day trader helps to sharpen your skills of being able to be a good swing trader. And in that respect, you combine all these tools to utilize this with AI, price action learning, all that stuff plays off. And then you get volatility into the market because you have a sitting president who's known to make the market volatile. Everybody can be a huge winner from all of this. And all you gotta do is trade the price action.
While you're on that, question for you, because you're probably looking at this more day to day than I am, was an article, I think, in the Journal the other day saying because Trump could say anything at any time, IVs were juiced. I keep an eye on SPY IVs because I do a zero DTE strategy but I'm looking more for, one date to be higher volatility than another so I can do a calendar. Are you seeing, or have you even looked for like higher implied volatilities now?
So I have a weird way of verifying implied volatility. And normally you'll see it fade in the opening hour and you'll see it increase in the closing hour. And the midday gives you an advantage for those zero DTE trade strategies, whether you're selling to open or scalping the movement on them. It doesn't matter what side you're on, it's a trade. I have a way of looking at it with a combination of delta and premium. Here's where it gets weird. I call it the pain zone. If you look at any zero DTE contracts, both call and put side, after about the first hour of market time, you'll watch these levels come closer and closer together, and certain spectrums come into play. So I look at whatever contract is selling for 4 cents on the put side and the call side. When they're above $8 apart from each other in SPY or Q, typically your 0 day is going to be better off selling to open. So you're going to be better off selling to open and just capturing that move. Where they get below $8 apart, they start approaching $6 or even $4 apart in some instances. And in a Trump administration, you'll see them get that close sometimes, probably in the middle of the day. That's where the day traders are going to come into this and scalp those 0 day contracts. The tighter that pain zone, the more delta you probably are going to have in it if something happens into the closing hour. So when they start getting between like 8 and 6 apart, I'll look for plays, and then I can go revert right to price action. I can use that as a gauge to figure out where I want to be, on which side of the market I want to be on. And in this case, if you're looking now, you'd see that zone would probably be right around the 526 or 525 strike, respectively, on the puts in the edge. Outside of that, you'd see like the 524, 523 probably be about 4 cents. I haven't looked at the contracts yet, but if you caught it in this high. So when that range moves around and it gets tighter, you have a higher probability of making a profitable trade, whether you're selling to open or scalping, where you're buying to open, selling to close. So if you utilize that and you watch implied volatility, you can watch that on a chart too. You can see it on a line chart, high and low implied volatility. Look at it from a spread point of view. Look at it as if it was a strangle with a call line to put in there, and it'll kind of lay right over that implied volatility chart. It'll give you the highest point of probability on an outcome. When it gets really tight towards the end of the day and it stays there, it's probably just going to fade and go sideways typically into the close, and that's very, very frequent that it will do that. But if you start to notice it get wider towards about 2 o'clock, that's when things are typically lining up for some sort of event that's going into the close, or you're going into an earnings announcement, something like that, where you get some expansion on that. So I gauge it in a different way, but it works the same. And anytime you see implied volatility kind of being crushed because you never know when Trump's going to pick up his phone and put something on Twitter, that can be both an advantage and a disadvantage in this game.
Why does the market always start selling off when we get on this call?
I don't know, man. I didn't tell anybody to sell, so we don't have that kind of
Yeah, no,
influence.
neither did I.
But I mean, we've been able to narrow down that today we're likely to grind in this range here. You can see I got some angulars in play here. Any break of this range here, we're thinking we could get a pretty explosive move. Either we're going to give half of this previous trend back, shoot down here to the 521 level, which is the low extreme overshoot, or we're going to run up into the liquidity zone up here or towards it and hit the 533, 534 level possibly. So we're watching this range and it's getting tighter and tighter and tighter. So I think the only news event we have on the calendar for data is like the mortgage rate comes out at what, like 2:30 or 2 o'clock or something like that. And we might have a Fed speaker coming on or something like that. But I don't think there's going to be really a lot of explosive moves into today until we break this range. Yeah, it is pretty interesting to see it sell off suddenly when we're talking. It is the middle of the day though. So
Yeah.
I always tell people in the morning, you know, when I'm done with my live stream in the morning, which is typically between 11 and 11:30, I'll go and say, well, you've made your lunch, you've made your sandwich, you've collected all the ingredients, you've got all this cash in your pocket, keep it. Go eat lunch. Don't let the market eat your lunch. You know, don't let the market take a bite out of your
Yep.
sandwich. And typically by about 11 to 11:30, the market tends to do stuff like this anyways. It'll fade down and kind of find a center over the middle of the day. And eventually you'll get a midday swing. Today you might not, but at some point, and then yesterday was a pretty good example. You had this lull, it's just this big giant, you know, cup looking thing. It didn't really get a huge swing until you started realizing that it hit the bottom of the range and it started picking up buyers into the close. So you got a pretty good trade there. But for the most part, during the middle of the day, all of this great price action was over. So, I mean, you can look, you know, right about 12 o'clock in this case, it was done. Any day you look at it, it's going to probably be pretty neutral in the middle of the day unless there's some sort of news-driven event. The other day we had a little bit of news, you know, fade this down back to a half back, and then it kind of melted back up to where it was. Pretty typical. And today we're starting with a range day, so we've got a little bit of expansion, but it's starting to contract into a wedge here. Eventually the wedge will break. It can happen today. It can go either way, or it can wait till tomorrow. And there's really not much you can do about that but scalp that range. This is what's great about futures trading. You can actually make money while the market's going sideways. So that's what we teach.
The other way you can make money when the market's going sideways, and often my favorite way to play, I think the market's going up, are high delta puts on VXX.
Yes.
Long dated 60, 70 delta puts on VXX, because that is a poorly designed product. The contango, you know, so if the market does nothing just from, you know, the role of the futures alone, this thing should deteriorate.
Right.
And, you know, if the market goes up a lot, it's going to deteriorate a lot.
Yeah, I mean, if you would have grabbed some 42 strikes the other day, you'd be sitting pretty right now. Heck, it might even complete a full MM and break that low and hit the 4170 area down here. It's a great.
So no, I'm talking about deep in the money stuff. So I have 80 strikes.
So you can go and you get the high delta that way, and that works too. I'm a weird trader when it comes to trading out of the money. I'm further out of the money than most people. But
I know we're different on the, and typically I'm going to trade stuff at the money. It's just I run some shorter term, you know, VIX ETP put strategies that I do at the money, and then this is kind of a longer term hold for me. So
right.
You know, I'll go out a few months and I'll do it way in the money.
On occasion, to do something like this for me to mitigate risk, let's say I was wanting to short this pop here, and I know where the reversion target is. if I'm pretty clear on that and I'm expecting it to melt down, you can go in the money, you can go out at the money, you can go out the money with outrights. Another strategy, if you're trading indexes, most of them are cash settled, so you can go and sell an in the money call credit spread, probably in this range here, about halfway between the mean and the peak here. And let's say you're selling $1 wide or $5 wide, whatever it is. When you get almost all of that position, so like let's say I sell a $1 wide for like 98 cents, that's only a 2-cent risk. And if it melts through it, it expires worthless. I keep the difference. And I have very, very little risk in that. Every once in a while, you'll see something like that play out, and you can catch it. Usually, first thing in the morning when the implied volatility is high, those spreads will become tighter and tighter, where the bid-ask difference between the two strikes will be so close in intrinsic value that you can get in for a risk of just 2 cents. So that's a way to mitigate risk on something like this. And if you lose 2 cents. It's a
Yep.
it's a neat play. It's just a way to mitigate risk on that to where it's way less risk than an outright. You're not always going to win those though. Sometimes you'll have a streak of like 20 or 30 of them in a row that lose, but when you hit one that wins, it absolutely inverts that streak of losers to the point where it's exponentially gaining even overall. So those are a lot of fun too. That's kind of my style. I'm a little bit weird when it comes to out of the money stuff, but I always look for the path of the least
Little bit
risk.
weird.
Yeah, true. I guess a lot weird.
Yeah, I'd say so.
But I'm in. I mean, it's for me. It's what works for me. I developed that because I'm just. I guess you can call me a cheapskate in that. I don't like risking a whole lot on stuff where my probabilities aren't dead on. With futures, it's a different
And
ballgame
again,
though.
that's where theoretically you could also, sell credit spreads and use the premium to buy, a levered or, a ratio spread or something correlated. I like to do that a lot. I just, I get the sense that the market's not doing a whole heck of a lot at the moment. So I have not been putting those trades on because you need a larger move.
Right.
But I mean, that's still one of my go-tos, especially when the market's sold off a lot and there's some potential, upside sitting there.
Like this one back here on the 20th. I mean, that was epic, just epic.
Well,
And
yeah, I mean, VIX moves, which is why, I mean, looking at that chart, why I run a short-term strategy where we're going to short the spikes and, and then we're going to get out and then we'll do it again and again and again. And, in my models for shorting the VIX spikes, I think are like, 80% win percentage. And I mean, just looking at the chart tells you why. I mean, VIX needs a reason to stay elevated.
right.
I mean, a stock can keep going up, 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 regardless of anything. It can defy gravity. VIX needs a reason.
Right.
All things being equal, people are not going to be afraid. Every once in a while, something happens, VIX spikes. I mean, unless the world ends, it's always going to come down.
So I mean, it's essentially, in inverse of the old one of the older Buffett strategies is to buy when they're afraid and sell when they're greedy. This just works
Right, buy when
backwards.
there's blood in the streets.
Right. And that's a neat way to look at it, being able to invert that and actually make both short-term and long-term income on it in that sense, because it's just going to always be trending down no matter what it does. And it becomes a game of whack-a-mole at that point. Just keep smacking it down, run it with puts. And there's other vehicles you can use. One we like to use when it's right, when it's got the right amount of volume in it, is the old UVXY.
Yeah, I mean, UVXY is typically where I'm going to do my short-term trading in.
And it gives you a little bit more percentage moves compared to the VXX. So the options will be priced accordingly. So you're not going to have as much of an opportunity to say enter those credit spreads for like 98 cents on the dollar wide, but it does happen from time to time if you sell it
What
into
what
money.
what I tend to do for credit spreads on UVixie is I'll do them on SPY
Right.
because it tends to be correlated. If SPY goes up, UVixie is typically going down.
And then recently I discovered that Robinhood started offering index trades, so you can go on SPX or SXP, and SPY and QQQ. If you're selling 0-day spreads, they get auto liquidated at 3:30. It's silly, but on the indexes they don't because there's no assignment risk. So if you wanted to cut your teeth on selling credit spreads, you could also use SXP. Take a very minimal risk approach to it to learn the process, and then you can carry that into SPX, and that's a lot of fun too. You get into SPX, it's a lot bigger number, but it does the same thing. It just makes bigger dollar moves. You can do some credit spreads on SPX and do very well, and still be outside of that silly auto liquidation at 3:30 rule. It really helps you. Been doing that before on Webull, where they don't care, they don't auto liquidate you on anything. But I like to keep my Webull as a cash account because I like to scalp outright options in it, and then my Robinhood's a margin account. So if you're going to do spreads, you have to have that margin ability. Whereas with Webull, it's easier just to do cash for me. That's all how you use your broker. You can use it any way you want, but that's just what works for me. But since Robinhood offers index trading now, it's on point. You can totally take advantage of that, and the commissions are pretty damn low.
So, couple of names I bought today, or one I added to. So, the AI healthcare theme, again, I continue to think is massive. We filed for an ETF on that the other day. So I'm looking to buy dips in these names. So RXRX I owned already, bought the dip in that today. It's not a great trading chart in that it's all over the friggin' place. But, I think from a long-term holding standpoint, you get a dip like this after a nice run. I don't mind this entry.
We could see a pretty nice little market structure set up on this, though, overall. I mean, yeah, it had this hype wave here that got capitalized, but we're making it's choppy, but we're making a beautiful rounding bottom here. And reversion's pretty obvious on this thing, about 1040. So from a trader's point of view, it's not useless. I think we could see some potential for a market structure move here. We just got to break 840 resistance, and it could be a good trend. Nice.
My other two favorite in the space, Tempest, which Nancy likes, and Schrodinger, SDGR. The reason I didn't add to those today is, they pulled back too, but from a relative standpoint, not nearly as much as RXRX.
Sierra Victor GR?
S is in Sam, D is in David, G is in girl, R is in Robert.
Gotcha. Sorry,
that's an interesting one. If you look at a monthly, see how far back it can go. Yeah, if you look at a monthly, back in 21, it was over 100. And then it's, it had a pop in 23, and then it's just really gotten its butt kicked. But now that AI in healthcare is a thing, actually looking at it on a monthly chart, it looks really interesting.
We talked about this one before at one point because I still have my liquidity.
Yeah, I've been trading this one on and off for years. Now that I think AI in healthcare is a thing, I want to hold on to it.
Right, it's got a great reversion target around $34. Right in that neighborhood. And it's just finishing the upper end of market structure. It could break out of this liquidity zone around 28 and make that move. It's got a pretty decent long-term setup.
Which brings up a good point why you sometimes, if I'm trading, I'm looking at daily charts, but sometimes it's helpful to zoom out because if you look at this on a daily basis, you're, oh my God, it's extended,
Right.
but you look at it on a monthly, it's still like 75 points below its all-time high.
Right. And I mean, you look at the entire structure here, it's like you had some outsized hype going into this thing like anything else when it's IPO'd. And then you get the capitalization time. This is where market structure really shines, and you can pay attention to short term on a monthly short term. This is each candle is a month. It's a lot of time. But you get a really good idea where the middle ground is, and you can find the center of gravity or the balance point or whatever you want to call it. It's just a reversion. And once it breaks structure of accumulation, typically it'll meet those reversions. So whenever you're looking at a choppy chart on a daily or 2 hour or wherever you're looking for your swing trade setups, don't forget to look left and look at all that time frame you can to the left on the monthly and weekly charts. And it sets you up for being able to kind of see the forest through the trees, so to speak. I mean, you look at the daily chart, there's a lot of choppy trees here, man. But you smooth it out with the weekly chart and like, oh, okay, this isn't so bad. Yeah, there's some volatility in here that's definitely for day traders, but it's also got some pretty good setups for long-term plays. And this is basic market structure play. Reversion target's obvious. You got a liquidity zone we just melted through. We're in the upper range of it. Break this level, go to this level. You can do the same thing with pivot lines. We used to do this we always do this with penny stocks still. We just look left, find the previous levels. In fact, that other chart that I was showing you earlier is a great example of that. I would start looking at that QNTM. So similar to learning market structure, you can look left and find these levels pretty easily. All you gotta do is zoom out, look for previous accumulation ranges. You'll see them, they chop around. Let me blow this up a little bit so a better visual. They chop around, kind of split the difference, find the middle ground, strike a pivot in there. And all you really need to learn to do is trade from one pivot to the other. When it's bullish, trade the bullish pivots in sequence. This pivot to that pivot to that pivot, and so on. When it's bearish, trade it in reverse. You can do whatever you want with it. But the idea is if you look left and you get data on previous price encounters, or price engagement, if you will, you can actually make a pretty good assessment of what the highest probability move is going to likely be. And then it's just a matter of waiting for one range to break and trade to the next range. So really just getting that data from the past helps you to anticipate the likely moves in the future. Always look left. That's kind of one of my mottos.
Yep.
So another
one, actually, I just went short, and it's been a high flyer, and I think I've talked about this before. I love to short the high flyers on key moving average breaks with tight stops, because sometimes they turn around and become high flyers again. Only do it with puts,
right.
So I know my maximum loss, but it's LUNR. That's been a retail favorite, but it looks like it's starting to curl. You got to make that bigger. There you go.
Yeah, I was zoomed in on it. Nice short-term reversion trade. We're just about there, but we could go even further and hit the previous reversion. Or let me look at liquidity zones. I like to look for long wicks on certain areas with the 2-hour chart to find those. And we can see it right there. There were some limit orders in that range. And if it continues to break down below this previous accumulation level, which it's testing now, we got a pretty good idea where it's going to go, about 1610. Be a decent short. If you wanted to kind of look at a way to range that, you can take the previous high and range it to about the previous low. I always say split. When you see an accumulation zone, split the difference. Draw your first box. Stack a box below it. Kind of funny, it gives you the same target. So knowing that liquidity zone, knowing what range to trade a break on, and knowing where your targets are always going to be helpful. And then I always tell people, write down the half and whole rule on a post-it note, stick it to your monitor or something. Half that move is 1790. So if it starts to accumulate there and you're short, you might consider taking some profit off there. If it blasts through it, cool, you can keep your exit limit order, like good till cancel limit order to take profit down here. At any time, you might need to abort that order and just hit the eject button, so to speak, and close it right out. So, and this works as well on a daily and weekly chart, and even a 2-hour chart in this case, as it does on a 5-second chart. It's all the same price action. You're just looking for primary impulsive moves, high probability of halfback. Sometimes it'll repeat a move. So you get a primary and accumulation, and sometimes the secondary will be equal to the primary in the same direction. When you start figuring that out, your trading consistency actually goes up considerably. But it takes a long time to learn how to ignore that monster in the back of your mind. It kind of tips you into FOMO mode, and you get afraid of missing out on these moves. Those will get you, and if you chase a primary move, they'll get you every time, because this is exactly what happens. People chase it, they get taken out here, and then it makes the move anyway, and then they're really pissed. So
Yep.
don't let your emotions be a trading tool ever, and avoid FOMO.
Another one I like here, NVIDIA.
Yes.
So NVIDIA sold off massively on the DeepSeek move. Today it moved above the open on that Monday, and undercut and rally at the 200-day. NVIDIA is just one of those names when everyone's telling you it's dead. And and all the analysis I'm seeing is that DeepSeek at worst is neutral
Right.
for NVIDIA, which theoretically means we might. I'm sure they've got earnings coming out at some point.
Yeah,
but
the 26th.
So we could go back up to. We'll see what the earnings are. Obviously, there's going to be a high hurdle here, but I still think NVIDIA is a must own from a long-term basis. And if you're trading it, it's a nice undercut and rally. I would have bought it yesterday, but still looking good.
I went the leveraged route. I actually went and sold $10 puts on NVDX again, capitalizing now, but
Beautiful.
I'm going to leave them. I'm going to let those expire worthless, I think. Same deal. I was looking left on NVIDIA, and I might do an in-depth deep dive technical analysis video on this later on that I'll put out on our YouTube channel. But I've had that 117 pivot on my chart for a long time. It's been a reversion target. It's been kind of a gravity zone for all of this price action leading into the previous pump. And then the sell-off kind of settled right around that area. It extended a little bit below it, but it was a pretty clean break back above it, and it was a great day to buy it, not just yesterday, but on the other day too. So in that action, right around that 117 pivot, first leg, I saw this drop down. I sold my first pile of $10 NVDX puts, sold to open. I intend to wheel trade that. I intend to own long where I can sell calls and puts on it, but I'm going to use puts to get paid for my position and the time I'm waiting to get assigned on it. Long story short, the next couple days later, or actually the next day, I was able to sell these at 90 cents here, buy them back at 30 cents here, and then I just waited till they hit the base again. I was expecting maybe we got a textbook double bottom here. Sold them again here, rolled them out a week, 90 cents again. And I bought them to close the next day on that at like 36 cents a piece. You get the idea. Sold them again down after this bounce. I didn't sell them here. I sold them here at 90 cents again, 14th expiration, and now they're probably trading for about 20 cents by now. I haven't looked, but this is kind of a lead into what I'm talking about with the wheel trade. Stuff like this is gold. You literally can get paid to wait for the price that you want to purchase it at if you want to go long on this thing. And then after the fact, you can continue selling out of the money puts and covered calls out of the range at the same time. If you sell them far enough apart from each other, your chances of assignment are lower. But because you're selling both, you're still gaining the premium that you would closer to the money. So it's essentially giving you more of a yield on the income strategy, the wheel trade. So start getting into that stuff. I'm going to start doing a bit of a series on that to explain my positions here with why and with charting and TA. But learn that strategy basic before you take it on, because there's a few things to pay attention to with that, so you don't end up one, sweating too much and panicking when it goes so far in the money that you start seeing your account look like you're having a loss. When you sweat through that, your heart will pound your first time you do this, unless you fully understand how it works. And if you keep your cool in that stuff and you realize that you're not looking at the short-term gains, you're looking at the long-term gains. And I'm talking about owning NVDX for free within a year or less, which is very easy, I think. Similar to what I did with TNA, same effect. I owned it for free between March and October. I had a negative cost basis on it. Same principle with something like NVDX, or if you want to own NVIDIA, it's probably better to do this with NVIDIA, but the yield's not quite as good as it would be on a leveraged ETF. So I always look for those leveraged ETFs. Thank you for providing that one, by the way. But when you get into that, it's going to really change the way you look at charts, for one. And two, you're going to look at being able to transition from a day trader to being able to trade similar to a market maker, but in an institutional fashion, if that makes sense. You're selling premium, and you're looking miles down the road and playing chess while everyone else is playing checkers. It's pretty cool stuff. I didn't want to take
Another one is Google.
Yeah. I didn't want to take up all your
Google
time.
Health. What's that?
I didn't want to take up all your time babbling on like that, but
No, that's fine.
that wheel
Google
trade is
held
good.
right where it needed to hold. So undercut and rally at the 50-day yesterday. I added on that dip. Tried to break the 50-day again today and held again. So I don't know. What do you think of this one?
So last week I put out an advanced charting video on Google, using Google as an example, and then I put out a couple other videos relating to it. But I call this the trap detector. It works really well, but also you got to take in perspective what your previous price action looks like. It did hold a key level. If you wanted to draw like a LZ off of this wick here, you can see it kind of lines up. Let's see if I can get the drawing tool to do it. Darn it, it didn't do it. Sometimes it gravitates, sometimes it doesn't. Okay, so we held that key liquidity zone. We knew there would likely be some buyers here. There's two ways to look at it though. This is one big bull flag. Everybody started chasing it here. I called this out as a trap detector because it's exactly what it does. Liquidity trap was right there. You can see the wick here. They hit it again. They didn't hit it this time until after it came back through. Again, earnings call, again. But now we're under the angular support of the bull flag. This thing, once it's built on that second impulse, here's where I mapped it from. It works this side too. We know where the liquidity trap is. There are some buyers here. I think you and I are interested in owning this for sure. So are the institutions. And knowing where these zones are is very important. If it breaks this zone, if Google's in trouble, and some rumors are kicking around that they may be in trouble for their cloud storage numbers not quite being where they wanted them, it can break this level, and we can see it come down to about 180, just eyeballing this range here. But for now, it's going to accumulate for a while. If it holds this level, I'm a buyer and holder, and I think we still have a pretty good shot at resuming the bullish measured move that I mapped out a long time ago here. But it did indeed reject the half move here. So it's kind of a, let's take caution, wait for some concrete evidence of a trend here before we start to decide whether we're going to buy or sell that. That's my opinion on it. If it eventually gets back to this zone and starts to climb up, we still have that outside target up here at 225. It is possible. And if you look at the weekly chart, that's peanuts compared to the previous moves. So it's definitely got that range potential, but here's where we're going to be cautious for sure. And looking at it from like a combined day trader, swing trader point of view, that's where I would say, yeah, shake your A, but watch yourself. In the words of Mystical. Oh man, but I do love Google. It's got such huge growth. And should we compare Microsoft a little bit?
Yeah, so you've got a lot of, I mean, this is an ugly looking chart, but I mean, you had that 410.72 January 14th low that had undercut and is now rallied back above. That if you were, I mean, if I were trading it, I'd probably use that as a stop. You know, I own it. I mean, it looks like it's trying to bottom. You know, they had their earnings already, so we don't have to. Did they? Wait. Yeah, I
Yeah,
think they had their earnings already.
yeah, back here on
so
the
we don't
29th.
have to worry about that. And yeah, I mean, another one of these that straddles so many different areas.
Right. I'm looking at the short term for a reversion range reversion on this trend here. So like short term, we could see a move back up to like 423, somewhere in that neighborhood. I know that they got bit a little bit in the earnings call, obviously, but now we're starting to see the old dead cat bounce. So we've got the range here. Anytime you see a big impulsive move, you typically map that half back is very likely. And in this case, it's just going to take a little longer. It didn't quite hit the half back on that impulsive move here to catch that half back, but we're accumulating. We've got a beautiful looking rounding bottom here. So as long as we don't see liquidity getting, literally sold to the retail traders right in here. And I don't mean to insult anybody with that. Everybody's got their own level that they're at. But if you know where to look, the institution's going to look to sell that. So if we melt through this zone, okay, we can shoot for that reversion target. But if we reject here, downside risk is huge. So I'm like kind of keep an eye on this level. If things get bearish here, yeah, we get a quick short, and then we get another opportunity to go long because it's another one of those companies you want to own, right? Even though it's been choppy and very very aggressively resistant to collecting long-term investors in this mess. But you got to remember, there's people still holding it from down here, and I don't think they're going to go anywhere. There's still some weight in this. We get pullbacks, we just get opportunities. And, short-term trading is going to tell you where all these levels are and give you targets. So in the meantime, I think this one for me is just a scalp the short-term until you see the long-term. Just my opinion on it. There was another thing we wanted to look at. I know Amazon's earnings are tonight, aren't they?
Right. Yep. They're tonight.
And then
So, I mean, I own it. I wouldn't play it.
Apple's already been out. So a lot of the weight in the indexes in like SPY and Q, overall it's neutral. So it would expect that unless we have a pretty good economic event happen anytime soon, we're likely to kind of grind along until the middle of this month, and then maybe we start seeing some swings come into view towards the end of the month. And that's kind of typical for February anyway. But yep. You get a lot of the big players or the gorillas moving the market around. My eyes are going to be on NVIDIA in this move first. And then I almost wonder if this tariff stuff's going to be accelerated by around that time, around the end of the month, around NVIDIA's earnings. I got a feeling, and maybe it's just a spider bite talking here, but my spidey sense is saying look for volatility in the last week of this month, and we should see some trends outside of that afterwards. So by weight anyway. And I haven't even looked at Dr. Copper yet, but I get the idea that there's some accumulation still happening there as well. So, we talked about one that we wanted to add to the list here today was VRT.
Oh, yeah.
So short term, I'm seeing a reversion trade, but what are we seeing long term on that one?
Yeah, undercut and rally at the 200 day. I mean, until this whole capex data center, issue really becomes an issue. Yeah, I think these are names you need to hold. I mean, yeah, maybe just make sure you don't get out over your skis on them.
Right.
But another one that is, so the DeepSeek open was 117.05, and it climbed back above that today.
So it's kind of made most of a reversal here. We're above our what I like to call the R1 right in here, and we're just sort of trending along in it. So if we get a range break here, the reversion target is pretty likely to get hit afterwards. So this gives us a pretty much ballpark target of about 125.80 for reversion, and that's the low end of this wick here, so it can overshoot that a little bit, and that's fine. But this is the zone we're watching, so it might give us that move. Anytime you break out of R1, you almost always test it as support, and we've already done that in the pre-market here. You can see it right on the open. It ranged it and bounced, so far it's looking pretty bullish. I like it, and eyeballing here, it's about a half move up to this target anyway, so we're in play. And then there's a couple energy stocks to go over real quick while we got a couple minutes. Are you still messing with TLN and CEG?
Of course.
So TLN, we were looking at the short-term play back to 233.70. It nailed that. That was a pretty easy trade. But now we're starting to roll. I would expect a rounding top range in here, similar to what we saw back here. But we may not be so bearish on this one. That had to do with, the DeepSeek thing, really. I almost wonder if we're going to start finishing the measured move on this guy, because that was right at the half measured move target. Liquidity overshot, and then blam, it got sold off. We may see a melt up on this one and attach to that mid zone on that liquidity, or that measured move here around 251. So keep an eye on the short term. If this ends up being one of those rounding tops where retail starts chasing it short, you get a long wick out the bottom and then a blast move up to the upside. Keep an eye on that. And I think if they try to overshoot that liquidity zone is going to be right here on this wick. So watch for a quick book flip on this, where you start seeing all the retail trying to sell it because they love shorting rounding tops because they see this. They're going to try and do that again. This is where I'd love to see the institutional buyers just come in and sweep this to the upside. I never short a rounding top unless it breaks key support, and I wait for it. This would have been a nice key support break. Yes, great short. But I'll never short that pattern. I wait for the break. That would not surprise me, actually. I think retail is going to try it. They may have already done it in the open here.
Yep.
Any other revisits? I know that we were talking energy here. Let me go to CEG real quick. I haven't looked at it in a day or two.
Yeah, I mean, CEG looks pretty good.
Still holding that ranged move we were talking about. Yeah, it's in the upper edge of the previous move. It could do it. Back to 345.
I mean, it's moving its way back.
Yeah, keep that on the burner there, but definitely be ready to see what happens after this doji party here. And then there was some other AI stuff that was kind of giving us some reversion, and one of them was Snow, and then we'll check C3 AI in a moment too. Snow was a great trade. We met our target on that twice, and now we're in that liquidity zone range. Can it accumulate for a while here before we see it follow through? We still haven't hit the half measure move target, but that was a gap up. So the fact that we're at the upper edge of liquidity here is pretty promising, but it doesn't seal the deal until we start seeing it break that range. So watch this for a couple of days, see if it breaks that range. A move above 190 should send it up another 10 bucks in the short term, and then long term it could still very easily hit that fib level up here, which is a full measure move up. So I'm definitely keeping an eye on this one. And then AI is the other one that's very different setup. We have not quite hit the bear target for this move back down, but now we're starting to build some momentum into a double bottom here on a daily, but on a 4-hour, it's more like a range play on liquidity. And until we break this high, we're kind of in a lurch on this one. But keep this on your radar. Maybe set an alert. I would say above. Okay. I would say wait for it to get above about 35.50 here. I'm going to set an alert myself. And if it starts to break that range, we can expect at least a short-term reversion back to halfway between the blocks here. And then if it starts to melt through that, we could see a trend out of that. So certainly AI has got a root in everybody's radar, and the more attention this one in snow gets, the more likely it'll be to follow through with those moves. And then there's quantum stuff. We got like a minute or two. Should we talk about the quantum computing stuff, or should we?
Let's save that. I have a hard stop at 12:30 today.
Okay. I'll give a quick brief on CrowdStrike then, because that one's been a freaking glory hound for me. Easily broke above that mid-range. I put an alert on our Twitter last night or the other day about this breakout move, and it is oozing on up to that 442 target. Just be a little cautious here in that quarter area, because we saw a little resistance here this morning at about 420, 421.63 was the high pop out on that. But we're still looking for continuation to just continue these little measured moves on a 2-hour, which it's notorious for. Apparently, we got 1, 2, 3 here. Same here, 1, 2, 3. Expect accumulation here, and we could see it break out and continue to melt up to that zone. But this is that other side note I always say to put on that sticky, on the half and whole sticky note. And sometimes quarters is a footnote on there because we're at that quarter level. Watch this for a pivot area, and if things continue to remain bullish on this guy, we'll continue breaking our elbow, patting ourselves on the back for having a killer call out. We're good at that. By now, we've both got tennis elbow, I'm telling you. What was the last one I wanted to look at real quick? Palo Alto. Still waiting for that reversion break. I lost interest in this one yesterday. It didn't quite get it, but now we're in it. Maybe I'll peek it again, but it's not so interesting anymore. Oracle. That's the one I'm really wanting to look at right now. So massive gappy chart, but we're in a key liquidity zone here. Also a reversion area, and we just wicked over it, came back for the test. If it holds support in this range, it starts to give us a trend. This thing is notorious for making big gappy moves. First is attack of the fib level here to like 186.50, and if it gets loose, upper range move to 196 is possible. And if it blows out, gosh, this thing has huge potential. But for now, look a little further left. This is still generally looking bearish, except this is a point where it can kind of pull a market spoof and run up. So keep an eye on this thing. It's volatile, it's nasty, it's a day trader's magnet, but we get it.
I like it as a long-term hold still.
Yes, and it is a monster.
All right,
move.
we should probably stop here.
Yeah, it's about that time.
So yeah. So we'll be back on Tuesday. Oh, there's my call. All right, I'm going to end this. We'll talk Tuesday.
We'll see you Tuesday, man. And then I'll get to the question on YouTube here as soon as I can. I'll put out a little video on that if I have to. Thanks, guys.